Goldman Sachs is forecasting that UK commercial property prices could fall by up to 20% by the end of 2024. Rising rates have increased costs for owners of offices, shops, and warehouses. A rush to exit property funds has forced fund managers, including Schroders, BlackRock, and Columbia Threadneedle, to suspend or delay redemptions from institutional real estate funds, at least until they can free up cash by selling property. Welcome to this edition of IG Trading the Markets podcast. I'm Jeremy Naylor. Roger Clarke joined us today. He's Chief Executive of IPSX, the world's first regulated stock exchange for real estate. Roger, it's a pleasure to be able to catch up with you. Thanks for your time.
Hello, Jeremy, and hello, everyone.
Now, let's take a look at this in some more detail. We know that property prices and property markets generally, not just commercial, but also, of course, residential, are in a little bit of a sticky patch at the moment. What are your views? And do you think that Goldman Sachs is right and commercial property prices could fall by up to 20% in the next year or so?
Well, it's interesting the 20% figure. Once I mean, one of the things I don't know what's going to happen over the next 24 months. It's a long time to forecast. Right now, Jeremy, though, one does hear anecdotally that anyone who's prepared to bid on sort of large ticket commercial real estate is tending to drop their bids by 15 to 20% from where they were 3 or 6 months ago. Not so much. I think that's probably people looking for bargains. It's probably people hoping to find distressed sellers, of which there aren't many yet. But certainly, sentiment is weak at the moment. Sentiment is weak.
What is it that's causing this weakness in sentiment? Is it political developments? And as we talk, we have just heard the news that seemingly is not so much of a bombshell to the markets because things haven't moved very much in the wake of the resignation of Liz Truss as British Prime Minister. Is what we're hearing about what's going on in the property sector the political turmoil? Or is it, do you think, more that we've got rising interest rates because inflation is generally rising? We know it's rising around the world. It's not just here in the UK.
Political stability is always good for markets, but for real estate in particular, rising interest rates tend to be bad signals for pricing. And we've had rising interest rates, as you say, globally throughout 2022 so far. It's interesting because ever since the fall of Lehman's and the global financial crisis back in 2008, we've actually had a fairly steady yield premium of real estate over the borrowing costs, real estate yields over borrowing costs throughout most of those last 14 years. And that is beginning to narrow now, and that will affect pricing. Now, the political turmoil you mentioned has had an effect, but it's had an effect because, of course, it's increased borrowing costs here in the UK. Although base rates or the bank's reference rate haven't yet been put up, the actual costs that people have to pay to borrow run off gilt prices and the swap curve that's based on gilt prices, and they've moved. And as you say, it's interesting that they've settled quite a lot since Jeremy Hunt was appointed as Chancellor. And even today, since the Prime Minister resigned, they've gilts have rallied a little bit. So those borrowing costs are in about 50 basis points from where they got to, but they're still quite a lot higher than they were before the mini budget. So yes, this current political turmoil does have an effect.
Let's talk as well about some of the mechanical movements, if you like, behind the headlines and this idea that these fund managers are scrambling, or certainly investors are scrambling to exit UK property funds. Maybe that's a bit of an aggressive word, scrambling, because I guess that many people are quite happy with the long-term prospects overall. But at the moment, at least, if they want some liquidity, they apparently are having to find ways of getting that liquidity by selling property within funds. How often does this sort of thing happen?
Far too often. I mean, there's a pattern developing. We first saw in recent memory this sort of problem with these open-ended structures that offer daily or short-term periodic liquidity from real estate funds. We first saw this as a problem in 2008. We then saw it again after the Brexit referendum in 2016. And of course, we saw it again going into COVID lockdowns of 2020. And now here we are again, just 2 years later. What is clear from this pattern is that even in markets where real estate, the underlying assets have been performing really rather well, those structures don't. You can't offer daily or short-term liquidity from an illiquid asset class like real estate in an open-ended structure. It works if, I mean, it's interesting, you mentioned, Jeremy, that people are probably happy with their long-term holding. Yes, real estate works if you hold it for the long term, and we see many successful private equity fund managers like Blackstone and Brookfield Starwood delivering excellent returns to their investors in funds that tend to have 10, 12-year lives or even longer. But if you want daily liquidity, it can only come from closed-ended structures like REITs that trade on markets that are designed to give daily pricing and daily liquidity. Because, of course, the underlying assets don't need to be sold to provide that liquidity. You get that liquidity by going into the market and selling to a market counterparty. That works.
So where are we then, and how, well, let's ask first of all about how you work with this sector as the world's first regulated stock exchange for real estate. Explain what you do and how you work with these companies and this sector.
Yeah, so we've set up a platform, a stock exchange, which on which companies can list their shares or securities. Those companies own single real estate assets or very concentrated portfolios. So when you buy a share of a company that's listed on our exchange, what you're buying is a share of a building rather than a share of a huge, great portfolio with lots and lots and lots of assets. When you buy a share in a traditional REIT, which has lots and lots of assets, what you're really doing is just handing your capital over to a management team to invest for you. And for some people, that's absolutely what they want to do. Of course, that can be the right thing. But some people would like to buy a single building. And the reason that us being a dedicated exchange just for real estate is so valuable for investors is what it does is it takes our companies and our assets away from all of the noise that you find on more broad-based stock exchanges like New York Stock Exchange or Euronext or the London Stock Exchange. They have lots of companies in lots of different sectors. They're very large and they move around based on macroeconomic trends, and they pull all of their companies listed on their exchanges with them. We don't get that. What we get is companies that trade absolutely in line with the underlying assets. Now, as you pointed out at the beginning of this podcast, real estate prices can go down. We're not pretending, we're not holding out, we're not mis-selling to anyone that prices can't go down. But what we offer is you will get the absolute value of the asset. So assets that are non-correlated to other markets are exactly what people need at the moment. Because, as we were saying, with all of this political turmoil, interest rates rising, equities and bonds are completely correlated at the moment, which means most people are really struggling to find anything to own that isn't falling in value quite hard right now. Real estate is the least worst place to put your money at the moment, because even a 20% fall compares quite well with stock markets this year and bond markets this year.
That's the interesting point, isn't it? This correlation of the markets, as you say, it gives no one anywhere to hide. What are you seeing in terms of activity? Are you seeing people wanting to pull money out, or are they looking for bargains? Are they still interested in investing at the right levels?
There's no shortage of capital that people have to invest and want to invest, and of course that stands to reason. You know, we have. We see, and it's not just because of COVID, we see a big rise, a secular rise over the last 5 to 10 years of people wanting to manage their own investments. There is a huge growth in self-invested platforms. There is an aging population worldwide that clearly, if they're looking to generate income from their assets, and these all point people towards real estate. You know, globally, half of all of the wealth that's owned is in real estate. That includes obviously people's houses and so on. It's not all pure investment income, but real estate is a massive market. We all use real estate. It's probably the one product you can think of that every single person uses and understands. And so there's a familiarity with it, and people are drawn to it. So at any given time, there might be certain areas of the real estate market, certain sectors that people are more keen to avoid than others. But no, we don't see, if the structure is right, there's definitely plenty of appetite for real estate assets as investments.
So where do you see as the area where there remains an appetite? Offices, shops, warehouses? What sort of sectors are we talking about where there is appetite? And of course, I'd like to ask the same of the other end of the scale in what is being dumped first in the current environment.
Yeah, I mean, it's interesting because for most of the last sort of 5 to 10 years, if you'd asked me that question, there would have been a fairly consistent answer about what was popular and what was unpopular. We've seen a lot of things turned on their head in recent months in the markets. But what do I mean by that? I mean the logistics sector, which has been the absolute standout performer, the darling of the broader real estate asset class, has been sold off quite heavily. I think largely because it has been so highly priced and has given such high returns that people have tended to try to take some chips off the table there. The things that continue to be popular are things which can provide inflation hedging, not surprisingly, and that tends to be interestingly two different types of real estate. And when I say types of real estate, again, it's the operating model as much as the actual asset class. So operational real estate, and examples of this could be student accommodation, it could be hotels, it could be self-storage, but these types of real estate where a lot of the lease length, if you like, is really quite short term, which means you can repeatedly resell the real estate to the user and therefore benefit from rising rental prices and rising prices. So operational real estate holds up quite well. And then at the other end of the spectrum, long dated leases with indexation in them. So leases which actually have inflation built into them. So as inflation rises, so will the rental payments that are owed rise, and so the owner of those assets obviously has protection from inflation by those long leases, especially if they are let to strong covenants, investment grade companies or even government organizations. So those two areas are very popular.
What will bring people back? Those 20% or whatever it is that's taken money off the table that will bring prices back down, according to Goldman Sachs, over the next couple of years or so. What will be the catalyst that brings the sector back into favor broadly?
Well, there always reaches a point where pricing works. As you know, real estate tends to be talked about and discussed, and the metrics are in a quite similar way to bonds. So people talk about yields quite a lot, and the inverse of the yield is that the price will fall. So if prices fall by 20%, then the yield that you will be earning on that real estate when you buy it will be rising. And it goes back to my point we were discussing earlier on about yield premium over gilts and swaps. Now, there comes a point where the yield that you can earn from the real estate starts to be attractive versus other asset classes on a risk-adjusted basis. Now, that depends from type to type of real estate. I would say today you might need a higher return from a shopping centre than you do from a prime London office asset, and perhaps even less from very long dated private rented sector rental accommodation. So, but it's when that yield premium resets, then people will start to want to come back because things will look good value again.
Mm. One final question is that we've got into this particular position. Let's hope that the political era is being cleared and we now get some clarity, some certainty, some long-term expectation back into the political environment, which of course you say can only be good news for markets. Let's assume that to be the case. Do you nonetheless still see potential further downside for this sector because of the other factors that have been affecting the entire economic environment so much? And that is the enormous amounts of debt that we all carry, both governmental, municipal, personal, whatever it might be, that, and also, of course, rising rates because of rising prices in food, supermarkets, and energy, and so forth. Do you see that there is yet still downside to come?
I honestly don't, Jeremy. And I'll tell you why. I mean, it's interesting. We all sometimes forget inflation is a year-on-year measure. Assuming that the recent rise in energy prices calms down and stabilizes, then I've seen some forecasts suggesting that within 12 months' time we will be back at 2% inflation. That might be optimistic, but the point is we are not going to stay with prices rising at 10% plus indefinitely. And I think we're beginning to see quite a lot of commentators suggest that as the British government seems to be beginning to head back towards a slightly more even keel and a slightly more trusted funding plans, that interest rates probably won't get to go quite as high as markets were predicting a couple of weeks ago. Might not even get as high as 5. So I think that this cycle will probably be a little bit shorter than it looked like when we were in the darkest hour sort of three or 4 weeks ago.
Okay, Roger, look, it's a pleasure to be able to catch up with you. Thanks indeed for your thoughts. It's good to be able to speak to you.
Pleasure. Thank you for inviting me on.
That's Roger Clarke. He's Chief Executive of IPSX, the world's first regulated stock exchange for real estate.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.